Alright, welcome back to the channel. So in this video, we're going to talk about tax planning strategies. So if the thought of tax planning strategy brings to mind, a fat, rich white guy sitting in the shade in the Bahamas, that's not entirely true. There are some of those kind of strategies, but they don't really apply to small business owners like me and you. In this video, I'm going to discuss the tax saving strategies that small business owners like me and you can actually use. Right. First, we'll look at the TFSA and RRSP. And yes, I know these apply to everybody, not just business owners, but it's also important for business owners to fully utilize these as well. RRSPs and TFSAs can help you significantly reduce the taxes payable and help you grow, build wealth tax-free. So let's take a look into each one. So when you contribute into an RRSP, you get a tax deduction for the year you made the contribution. So it's going to lower your taxable income for the year, which should have you paying less taxes, or if you're on payroll, it'll actually get you a tax refund. So this is great. And the money that you invest inside the RRSP, you have the option to invest it into things like a high interest savings account, mutual funds, or even individual stocks, depending on your risk tolerance. The important thing with RRSPs is, although you get the tax deduction, you make the contribution, when you decide to withdraw that money to spend it on personal things, that withdrawal is going to be added to your taxable income that year. So you get the deferral now, but then you'll be paying more taxes later. To be most efficient with RRSPs, the whole idea is you contribute into RRSP when you are at a high tax level. So your marginal tax rate is high, you get the contribution, it lowers your tax rate. And then when you make the withdrawals, you want to make it in years where your taxable income is low. So it's going to be added to your income. But to take advantage of marginal tax rates, you're going to be paying less tax overall. Next up is the TFSA, so the tax-free savings account. I still see some confusion in some people about this, so this is a great opportunity to talk about it. So tax-free savings account, you don't get the tax deduction like you do with the RSP when you make a contribution. The money inside the tax-free savings account is just the same. You can invest it into interest-bearing accounts, mutual funds, or even individual stocks if you like, depending on your risk tolerance. And then when you withdraw it, unlike the RSP, it's not added to your taxable income either. So you get to withdraw the entire amount tax-free. So in short, the TFSA allows you to grow your investments tax-free. So if you have a large time horizon or your investments grow significantly, then the TFSA is a great vehicle for you to build, some serious wealth. So a question I get all the time, which one is better, the TFSA or the RSP? Well, like most things accounting and finances, it always depends on your unique situation, but there is a bit of a general guideline. So if in the current year, you're at a higher tax rate, it might be more beneficial for you to contribute into RSPs, because that'll lower your taxable income and you'll get an immediate tax refund or less taxes to pay in the current year. Or if you're young and you don't have high income and you also have a long runway, a lot of time for you to build, these investments and let them compound, the TFSA might be the better way to go because it'll allow you to accumulate wealth, grow your investments year over year over year. Think 20, 30, 40, 50 years, how much that would be, and you get to take all of that out tax-free. And lastly, it would be beneficial if you can, I know finances are tight, especially right now for a lot of people, if you can contribute and max out both, that's a great way to save for retirement and also to help you build a little bit of wealth. The next strategy we're going to look at is incorporating your business. So this one is huge and one of my favorite tax planning strategies for small business owners. Incorporating your company is going to allow you to lower your taxable rate for your business income. So this is going to allow you to reinvest your profits inside the company, spend more on sales, marketing, operations to earn even more profits down the road. Recently, the government has made some regulations on things like income splitting and making investments within your corporation. But overall, if you look at an incorporated company, it actually helps the government earn more income. So if you have more profits in your company, they're taxed at a lower rate. That gives you more capital, more spending power to hire more people, and then those people are going to be earning income and then paying personal taxes on their wages. So incorporating companies are here to stay. I don't think the government's going to mess around too much. Overall, the government is winning from incorporated companies paying lower taxes. The only negative, but not so negative thing about incorporating a company is I'd say there's going to be higher costs. So the cost to set up, the administration costs, the filing the annual reports, and then filing your corporate tax return and paying an accountant. So you're probably looking at another $3,000 to $4,000 per year. But don't let that scare you. If you have a profitable company and there's more money left in the company than you need for your personal expenses, the benefits of incorporating are going to outweigh those costs significantly. So think of it more as of an investment than a cost. So let's look at some of the benefits once you've incorporated a company. First, you limit your personal liability in the business. So if something bad happens in the business, it's just dealt with the business. Your personal assets are protected. Second is we got something called the small business deduction. So in BC, that means the first $500,000 of profit is only taxed at 11%. Next is incorporating gives you access to something called the lifetime capital gains exemption. So essentially this means if you've incorporated a company and you decide to sell it, a few years down the road, you can actually sell your company for almost $1 million, and that $1 million would be tax-free to you. That's right, $1 million tax-free for selling your company. This should be the goal for all small business owners eventually that are looking to exit their business. Next up, income splitting. The government's made some changes to these rules, but if you have family members that are actively involved in the business, they're being paid reasonable rates, you can take advantage of splitting your income with your family members. So you guys all take advantage of that marginal tax rate. So instead of one person paying a super high tax rate, you're all paying somewhat of a lower tax rate. That's a huge benefit and a huge potential to save taxes there. And finally, income timing. As opposed to, sole proprietorship, with an incorporated company, you get to choose when you're gonna pay yourself. So if you need a mortgage, you can bump up your salary. If you don't need that much money, you can keep your salary low or your dividends low and reinvest those profits. You can defer taxes. So you only have that option when you are in an incorporated company. So huge benefit there. So now you know the benefits of incorporating. When is the right time to incorporate? Well, if you're in an industry where liability is an issue, like construction, then you want to be operating from an incorporated company right from the beginning. You don't want that personal liability to fall on you. And then next, if you don't have too much liability and you're incorporating just purely for tax planning, you want to incorporate when the company is making more profit than you need for your living expenses. That's the only way the tax deferral is going to make financial sense. If you're withdrawing all the money you need for your personal expenses, you're only going to incur more accounting costs and you're not going to get a tax deferral and you're not really going to save money. You're actually going to lose money. So make sure the company is profitable and it has more profits than you need to sustain your lifestyle before you incorporate. Last note on incorporating a company, I see this all the time. So don't just incorporate and forget about it. That's not how this really works. So if you incorporate, you need to keep up with your monthly bookkeeping, your accounting, all that stuff needs to be ready and go so a tax accountant can look at it and provide tax planning strategies. If you just leave it there for years and wait until the CRA, sends you letters to file, there's not much tax planning that can be done after the fact. You have to be a little bit proactive. So think about the incorporated company more of an investment to you. You'll get out of it what you kind of put into it. Make sure that you link up with a good accountant that can, help you navigate how to operate an incorporated company and help you save taxes. Again, consider it more of an investment. Whatever you pay your accountant, whatever you pay the cost to incorporate your company, you should be seeing a significant ROI on those costs. All right, so leveling up to the next level of tax planning. So setting up something called a holding company. A holding company will help you with tax planning and also help you protect your assets while you build generational wealth. The first main benefit of a holding company is asset protection. So instead of holding your assets in the operating company, where you're conducting business operations, you hold your assets inside a holding company. What this does is gives you an extra layer of protection. So in case there's any litigation or anything comes up like that, the assets are owned by the holding company. So, creditors or litigators, they can't go after what's in the holding company. So extra layer of protection for you. And then next, to claim that $1 million sale that we're all hoping for, to qualify for that, you have to prove that most of the assets in the business were actually used in business operations. So if you own a construction company, but then you have rental properties and that's the bulk of your $1 million, CRA doesn't want to see that you're transferring land or a condo or a house and taking advantage of this lifetime capital gains exemption. It's solely for business operations. So to qualify, you don't hold assets in the operating company. You have to move them up into the holding company. That'll still keep you qualified for that lifetime capital gains exemption. And then finally, if you're in some kind of partnership or if there's more than one shareholder, having a holding company and then each of you owning the holding company gives you more options on how you guys are going to pay yourselves, right? So especially with partners, you guys have different life events. Some people need more money sooner than later. Moving that money through a holding company allows the both of you, or more if there's more than two partners, to be able to take that income when you need it and then be taxed separately on how you need that income. Leveling up, we're going to look at health insurance and health benefits. So health benefits is a little bit risky, considering that the government is starting to look at this as a taxable benefit, although they haven't confirmed that anything's going to happen in the near future, but it is a possibility. So health benefits are a win-win for the employer and the employees. Employees could be the owner of the business as well. So health benefits are an expense for the company. So when the company is purchasing, these health benefits, it's a complete write-off. When the employees, including the owner, receive these benefits, they're tax-free currently. So it's a win-win situation. Health benefits are great. And life insurance can be another tool for building wealth, and life insurance shines more when it comes to estate planning. So when a business owner is looking at, what they're going to pass down to their children, life insurance can be a good tool to use. So let's take a look at an example here. This would be the easiest way for me to demonstrate this. Let's say John is the owner of an incorporated company. He has two options when it comes to passing on his legacy or his business or, his money or his assets to his children. So first, his company is making more money than he needs to sustain his lifestyle. So A, he can use those profits and invest openly in securities or stocks or whatever, and then he can pass that on to his children, or most likely they'll probably sell all that when he passes away, but that'll incur a lot of taxes throughout the growth and when things are sold. Another option here is for John to use the profits in his company to buy a life insurance policy. The company would purchase the life insurance policy and the company would be the beneficiary. The key here is some life insurance policies let you contribute more than the actual monthly premiums. And what that allows is it allows that money inside the insurance policy to grow tax-free. And then when John passes away, the life insurance policy is paid out to the company. But since that money was allowed to grow tax-free, the amount of money that's available for John's kids is going to be a lot higher than if he had invested it outside the insurance policy and paid taxes on the growth. If you structure the life insurance policy properly, John's kids might even be able to take some of that money from the life insurance policy payout tax-free as well. Life insurance policy could be a great way to do some estate planning. Finally, we got tax havens and tax loopholes. So this is that thought of that fat rich white guy in the Bahamas, smoking a cigar, laughing all the way to the bank. So there are these strategies, but again, these are kind of for the super rich. And the reason why I say that is because, you need a team of tax professionals, you need a tax lawyer on speed dial to make sure all this happens. The reason is some of these loopholes, which is what they are, loopholes, CRE will try to close them. And once they're closed, these strategies become tax evasion. And tax evasion is criminal. You can be sent to jail for tax evasion. So unless you have the money to, pay the retainer for a really good lawyer, that can help you with these strategies and be up to date with all these current rules, then it would be beneficial. Normally for small business owners like me and you, this is not viable, but don't let that discourage you. The previous strategies that I discussed are all available to small business owners like you and me, and will help us reduce our taxes significantly over the course of our entrepreneurship life or journey, or whatever you want to call it. But the tax savings are there, the strategies are there, you just got to implement them. If you have any questions, leave me a comment, and don't forget to like and subscribe. I'll see you on the next video.